Have you ever wondered how to invest without having to sit there picking the right stock, without studying charts for hours and hours, and without being afraid of losing everything? Well, guys, the solution exists, and they're called ETFs. In this video, I'll cover the basics to help you understand and invest in ETFs, to actually start investing your money without taking huge risks. I'll explain it simply, without difficult words. Because, as you know, I'm not super technical, but what matters to me is that the people who follow me at least know the basics of investing. ETFs are definitely one of the products you absolutely need to know about. It's nothing complicated, and if you do something reasonably smart, there aren't any major risks. So it's really a product that's suitable for anyone who wants to start investing, especially for those who want to set up a long-term accumulation plan. Point number one, we need to understand what Exchange Traded Fund SR. Exchange Traded Fund stands for Exchange Traded Fund. In simple terms, what is it? It's a fund that you can buy on the stock market. Now, it's kind of like a stock. Let me put it simply for you. It's not just one stock. Because inside it we have different products. We can have stocks, bonds, commodities, various things. And what does this help us do? To reduce the risk. So basically, instead of buying individual shares of, I don't know, Amazon, Apple, Tesla, Microsoft, you buy a product where all these stocks, or at least some of these stocks, are included. Then, of course, it depends on the exchange-traded fund you choose, okay? But if we want, we can also buy more than one exchange-traded fund. Okay, but we'll look at this calmly later.
Let's use a practical example to explain ETFs and why they're better than buying a single stock.
Try to think of a basket of fruit, okay? You can have a basket with only apples. Now, if you buy just one apple and that apple goes bad, you've wasted your money, right? With an exchange-traded fund instead, it's like buying a basket that contains apples, bananas, oranges, tangerines, and kiwis. I mean, do you really think all of them could go bad? No, even if one of these fruits rots, the others make up for it, and as a result, you reduce the risk of loss. So, what are the advantages of investing in ETFs? One is automatic diversification. One of the key principles of investing is to diversify. What does it mean? The example I gave you earlier? That is, if we take many different things, it's very unlikely that all of them will go badly. Especially if you learn even just a little the principles for choosing fruit. The exchange-traded fund does this automatically because a single product contains different products that are already diversified within it. So for this reason, you don't even need to be a super expert or understand charts, candlesticks, this, that. No, it's really one of the simplest investments currently available on the market. The other advantage is the low costs, because ETFs have a very low management fee. If we want to give an example, ETFs are kind of the evolution of mutual funds, which on the other hand are active investments, while ETFs are what we call passive investments. Why? Because active investing means there's a person who actually sits down and decides how to invest, how to diversify with individual products, rebalance the portfolio, and so on. There's work involved that must be paid for, so it costs more. ETFs, on the other hand, which simply follow and replicate the performance of certain indexes, are so-called passive. They have passive management, because objectively there's no person behind it doing this kind of operation. This leads to lower costs. Another advantage is transparency. That is, at any moment you know exactly what's inside your exchange-traded fund. The last advantage is liquidity. That is, you can buy and sell ETFs at any time and therefore have liquidity at any time, in case you need it. Now, how do ETFs work in practice? As I was saying a little while ago, each exchange-traded fund has a reference index and follows its performance. Now, let's take the example of the S&P 500. The S&P 500 represents the 500 largest companies in the United States of America. What does the exchange-traded fund do? It tracks this index's performance. So if the S&P 500, for example, goes up, let's say by 5%, the exchange-traded fund will do more or less the same thing. It's the same. If it goes down, it does the same. But why? Because it doesn't try to beat the market. It simply follows it. How do you buy ETFs? What you need to invest in ETFs, though, is a broker or a platform. The problem, though, is the fees, because sometimes if they're too high, they still end up eating into the returns on your investments. And that's something you should keep an eye on. That's why when we invest in ETFs, except for a few cases, we need to choose a platform with the lowest possible fees. One of the platforms I use is Naga because it has 0 fees on ETFs, which is not something to underestimate. In addition, if you have money but don't want to invest it yet, Naga gives you the opportunity to earn returns on your uninvested cash. Just leave it there and you'll get your returns without doing anything. Obviously, we're talking about a gross annual return of 2.4% application programming interface with the Naga Earn product. With this product, you have maximum flexibility. You can withdraw at any time without any problem. But the most important thing is to know that Naga is a highly reliable and regulated broker in Europe. In fact, it is authorized by SAISEC, registered with BaFin in Germany, and very importantly, with Consob in Italy. The app is very easy to use. You open an account for free, and if you deposit at least 50 euros, you'll receive a free stock worth between 25 and 100 euros. Click the link in this video's description to open a free account. But now let's move on with the video to better understand the topic of ETFs. So basically what you need is an account and a strategy. But ironically, you can start investing in ETFs even with 50 euros a month. You don't need a lot of capital, but you can use your own. The long-term strategy. This is another strategy that allows you to reduce risk. Because if you invest in the short term, maybe in an exchange-traded fund that's mainly made up of stocks and therefore tends to fluctuate a bit more. And if you invest for maybe 6 months, that exchange-traded fund might be at a loss, and so you're losing money. But in the long term, it's been shown that all indexes tend to go up. What do we mean by long term? At least 5 years, even better if it's 10, 15 or 20. Because the leverage of time is truly powerful, especially if we combine it with the leverage of compound interest. I'll explain that in another video. ETFs. Another particular thing about them is that there are 2 types of ETFs, namely the accumulating ones. If you look at the nomenclature, at the end you always see either ACC or district in parentheses. What does that mean? Accumulation. Accumulation means that every time the money you earn is reinvested in the exchange-traded fund, so it helps you take advantage of compound interest. Or distribution, on the other hand, they distribute the dividends, let's say every so often. So what you earn is given to you. Okay, this is a choice that everyone makes for themselves. Another thing to look at before buying is the type of replication, because there are 2 types, physical replication or synthetic replication. Another thing to consider is the cost known as total expense ratio. You will see this when you go to check out the products in the information sheet, because every financial product has a sheet where the composition, the sector, the geographical distribution, the performance over the last few years, and also the costs and everything else are listed. You need to look at the total expense ratio because obviously we need to understand how much we're paying. This is important because we need to invest with awareness, not like many people I interview on the street do. Maybe you've seen my show, How Do Italians Invest? There are people who rely completely on their bank advisor without knowing what they're investing in, how much they're paying in fees, or what the risks are. They know nothing, so you should avoid that. Please guys, do it. I'm not giving financial advice, I'm not a financial advisor, but, well, these are kind of the basics. Another thing to look at is the size of the fund, because obviously the bigger the fund, the more stability it gives us. And you can also see this in the exchange-traded fund's information sheet. And then, lastly, you need to check whether it is harmonized or not. We may cover these topics in more detail in other videos. Let me know in the comments if you want specific videos. I would really like to make a whole series of videos about ETFs, because they are a really convenient tool, perfect for those who want to start investing. Mostly safe, but still has some risks. Because all investments have a risk, bigger or smaller, depending on what we choose. But in any case, investing involves a risk. We need to know this. But let me know in the comments so I can start making more content on this topic. Point number 5, as I mentioned just a moment ago, is risk. That is, even ETFs can lose value. It's not the kind of investment where your capital is guaranteed. So we might also find our fund at a loss. This is especially true in the short term. But as I was telling you before, if you hold them for the long term, Maybe you even set up an accumulation plan for 10 or 20 years. I don't know, maybe to have some money when you retire or maybe for other things. So, it's definitely the perfect tool. Please don't make the mistake, which is the biggest mistake, of selling when you see your fund going down, because that's the moment when you're losing money. I mean, until you sell, you're not really making or losing money. That's why in those moments we shouldn't panic, which is what's called panic selling. And so we sell our funds because we see them going down. If you think in the long term, it's been proven that funds go up. But obviously, as I told you and I'll repeat, long term means at least 5 years. In conclusion, guys, ETFs are one of the simplest and most accessible tools for investing today. Even for those who are just starting out, even for those who don't have large amounts of capital. Because as I was saying, you can easily set up a plan with 50 euros a month at first just to get a sense of how things work. This shouldn't affect your life. If you need that 50 euros for groceries, then no, guys. Then a premise about investments. Obviously, before investing, we need to have our emergency fund. We need to be aware of where our money is going. We need to know how to manage our finances. So we need to have some margin in order to invest. Then we can do it with peace of mind. And don't be ashamed. You can start step by step, even with just 50 euros a month. Why not? You might think it's not much, but then things evolve. So you can easily start little by little, understand how it works, and then maybe start investing a bit more. Please comment if you already invest in ETFs or if this is your first time hearing about them. I'm interested because in fact the channel will have a bit of an evolution. I also want to discuss investments and understand the experience level of my followers. I already know that many of you are quite experienced and already invest. But I also know that there are people who want to start investing, but don't really know where to begin. That said, leave a like, subscribe to the channel, and as usual, I'll see you around.